Good morning, everyone, and thank you for joining us at the ESG for Small Caps webinar. With investors and stakeholders having a sharper focus on ESG credentials, it is now essential that companies are focused on it too. ESG practices are not a why question any longer, and in line with this shift, we felt it would be important to hold an event which cuts across the various challenges in actioning and reporting on ESG initiatives. We hope today you will come away more informed about the tools and practices available to help companies integrate ESG practices and reporting into their businesses, and in the process, unlock real value. We have assembled three fantastic speakers who will each provide some very unique insights into ESG and how that fits into their respective organisations. We have Hammond, Impact Investment Program Manager, at the Responsible Investment Association of Australasia. Emilie ONeil, the co-head of ESG and Equities Analyst at Perennial Partners, and also Tim Siegenbeek van Heukelom, Chief Impact Officer at SocialSuite. The format for today will see each of our presenters deliver a short presentation, which will be followed by a panel session at the end. During the panel session, you are encouraged to submit questions for any or all of the presenters using the submit question bottom box below. We have a sizable audience made up of predominantly ASX listed company executives who are keen to hear more about ESG and how practices and systems and processes and reporting can fit into their respective organisations. With the formal proceedings out of the way, I'd like to welcome our first presenter, Hammond, from the Responsible Investment Association of Australasia. Carly, over to you.
Hi, hopefully everybody can see my presentation now, and yeah, it's a great pleasure. Thank you, David, to be here today. Before I kick off walking you through a little bit more about RAIA and ESG, I'd like to acknowledge the traditional owners of the land that I'm on here today, the Wurundjeri people of the Kulin Nation, and pay my respects to their elders past and present. So it's really great to have this audience here to talk to, because I think what we're seeing is every day in the news, the words ESG bantered around, particularly in regards to climate change, but absolutely not limited to that. And so it's becoming more and more relevant for the corporate sector, for companies small and large, to really wrap their heads around what this means to remain attractive both to their customers, their clients, but also to investors. So I'm just going to give you a little bit of a background about my organisation, RAIA, Responsible Investment Association Australasia, a bit of a mouthful there, but we are essentially the largest and most active network of people and organisations in our region engaged in sustainable finance. And so we are a not-for-profit structure with over 500 members, including super funds, fund managers, financial advisors, asset consultants, organisations like SocialSuite, who support the corporate sector with impact reporting, and also Perennial is a member taking part today. And so our mission is very much about championing a more sustainable financial system in Australia and New Zealand. And fortunately, the wind is blowing in that direction. So I wanted to just talk a little bit about the growth of the market in responsible investment, and I don't want to bore you with too many figures today. But what we see, we track the growth of the industry over every year in Australia and New Zealand. And these figures are very much from our benchmark report. But to be honest, I could have put a plethora of local and global studies and data in front of you that would show really just one trend, and that is that money is moving into responsible investment. Usually we also see the growth of the broader market happening alongside that, but in Australia last year it was interesting because we had a bit of a stunting of the overall growth of total managed funds, but we saw responsible investment funds growing to 40% in that year. So what that's actually meaning is money is moving out of traditional financial products and into products that have got a responsible investment mandate process and can talk to that. In terms of why this is happening, obviously, I think there's a number of reasons that I want to talk to today, and I think it's an interesting one because the returns has been debated for years. There was a myth that was around for a while that you would really suffer if you invested in responsible investment funds, and we're really seeing that turned around, and I'll show you that in a minute. But also client demand, and I think any financial advisor or super fund these days will talk about their members and their customers and their clients just getting on the phone and asking questions that they've never asked before. What are the holdings of my investment? I want to know more about it. And then finally, I'll talk to compliance. And this is the one that's a real area to watch, because I guess what it's saying is that even if you don't acknowledge the returns, the financial merits, and the consumer demand of it, you are going to be hit with this ultimately anyway in a compliance context. So just first on to certified products. RAIA does certify, and I think Perennial is a product certified by RAIA as well. We certify products for being true to label responsible investment products. So a very rigorous process that goes into that. We have around 250 odd products. And what this data shows us here is how those products are performing versus the average funds in the marketplace. And what we can see there and over the different time periods is actually the outperformance of responsible investment products. The more that the sustainable finance market grows, the more that we'll actually see that leveling out actually, because we, the sustainable finance market, are becoming the broader market too. But still very, very encouraging results that again are mimicked in global markets everywhere. Turning to consumer demand, every year RAIA does a consumer study, which we did a few months ago, asking Australians around their different expectations and awareness of responsible and ethical investment. And this year the figures were pretty conclusive in terms of the expectation that people want the money that's in their bank account and the money that's in their superannuation and other investments to be invested responsibly and ethically. And I think we've seen a little bit of this play out in the recent election, which some people have been calling an ESG election, where those issues that have been bubbling along for so long have really risen to the fore, and obviously mirrors that very much, that sentiment. What we also see with this audience, what we also see with this audience is that 74% of people would consider moving to another provider if they found out their current fund, whether that's a super fund or a ETF or a savings account, was investing in companies engaged in activities inconsistent with their values. Super fund at the top of the list, but it still flows through to other products as well. And I just want to talk, this is a lot of text on this page, so I don't necessarily expect you to read it all, but what I really want to reinforce is the tightening up of the regulatory environment here in Australia. Not just with an election result. I think this would have been very much the same slide 2 weeks ago, because what we've got is so much happening globally in this space. And when things happen globally, financial markets, even if you're in Australia, you're not immune to that. So, particularly the sustainable finance disclosure regulations that we've seen developed and rolling out in Europe with a sustainable finance taxonomy, that's already been absolutely flowing through to the investment community here in Australia. Similarly, we've got New Zealand, which for example, from next year, disclosures on climate risk will be mandatory for large publicly listed companies and other investment organisations. Here in Australia, financial advisors must already be considering the broader long-term interests of their clients and, where appropriate, limiting product recommendations to sustainable investment products. So they're needing to wrap their head around this space already. And then I guess the big one that's quite interesting right now is that, and this was announced at the climate meeting late last year, COP26, the global accounting body IFRS Foundation is currently developing standards that will provide a global baseline of sustainability disclosures. That's a global initiative. It's got big resources. It's got all the different accounting bodies across different jurisdictions, including Australia, very involved. And the Australian government has already indicated that they are committed to implementing them. Whether they're mandatory is yet to be seen. But that's a big shake-up in corporate reporting landscape, because it's not just accounting, looking at numbers, it's looking at how different issues are influencing a company's bottom line and where they're material or likely to become material. What I wanted to do here, this is, again, don't try and read the whole thing, but this is a schema that really unpacks all the different types and approaches to responsible investing, because it can get really confused. We often call it the alphabet soup of responsible investment. But what we've got there along the top, those 7 different areas, is different ways that a fund manager such as Perennial or a super fund will engage in responsible investing. One of those ways, exclusionary negative screening, that's probably the one that we often hear the most about, where a fund just has policies and decides, for example, to screen out tobacco or nuclear weapons, for example. Then we've got corporate engagement, shareholder action. Obviously, there's lots in the news on that at the moment with AGL, but that's essentially where a manager stays invested in that company, believing that they can influence the company at a governance level to improve its performance. Impact investing, quite possibly the most potent end of this continuum, where the investor is investing very much to achieve positive social and environmental impacts, and to be labelled as impact investing has to measure and report against these. And then on the far left, what we've got is ESG integration, which is really, to be honest, becoming the floor of mainstream investing these days. We, as an organisation, we expect responsible investors to be doing a combination of these strategies. To be doing ESG integration is not enough. However, that's the most popular responsible investment strategy that pretty much all responsible or sustainable investors will be engaging in. And that's essentially including environmental, social and governance risks and opportunities into the financial analysis and investment decision-making process. So nearly at the end of now, but I just wanted to highlight some of the themes that would be covered by ESG integration from an environmental and a social and a governance perspective. So we often see things playing out around gender ratios, internal culture, executive remuneration for governance, and then environment, probably no surprises there. Social, we now have modern slavery legislation in Australia that certain size companies need to report against, but health and safety, data privacy, the list goes on with those. Again, coming back to our consumer research, you can see some of the most important social and environmental issues that consumers are caring about. So animal cruelty tops the list year on year, really, closely followed by human rights abuses, environment, all different types of environmental issues rate here. But you can see there's a lot of issues that people are caring about, and not always the financial products to do that. Again, I just wanted to show you here when people are thinking about what kind of positive impact they want their money to be achieving, you can see there that environmental's top of the list, renewable energy's front of mind, but it's followed also by healthcare, public health and medical products. Potentially something like COVID has influenced that, but we're still seeing zero waste as another key theme, another environmental theme, healthy rivers as well, and sustainable water use. So really that's just to give you a snapshot of I guess where the market is at, both in terms of consumer sentiment, but also where we're seeing that growth and why that growth is happening. So I'll hand back now to David. Thank you.
Thanks, Carly. You've really set a great overview of the ESG environment and how and why it's becoming more and more relevant to ASX-listed companies. Just a reminder, we are holding all the questions to the end. So I will say thanks, Carly, and we'll bring you back in a little while, and make sure people, if you do have questions for Carly, that you do write them in the Q&A button at the bottom of the screen. So thank you very much, Carly. Next, I'd like to welcome Emilie ONeil, co-head of ESG and Equities Analyst at Perennial Partners, who will provide insights into what she and her colleagues are looking for from an ESG perspective, and how you need to consider these to ensure your company doesn't shut itself off from a range of investment options. Emilie, thanks for your time.
Thanks, David. I'm really excited to be giving the fund manager perspective in this presentation today, and of course, happy to take any questions at the end. But I guess I wanted to take you through the landscape for sustainable investment and what we look for from an investment perspective, some of the differences in small caps versus large caps that I see, and a couple of the different investment strategies that we deploy here at Perennial, and how, no matter whether it is our dedicated sustainable fund or our broader Perennial funds, we consider ESG to be very important for all of our holdings. So next slide, please. So this is just a little bit of a landscape about who we are at Perennial. Hopefully some of you I already know on the call, but we are an Australian-based investment manager. We've been around for quite a long time. We were founded by John Murray over 20 years ago. We currently have over 8 billion in funds under management. And we do consider ourselves to be a leader, or at least we try to be a leader in sustainability and ESG. And thank you, Carly, at RAIA, because we are a certified responsible investment product, our Better Future Fund, which I primarily work in, but also Perennial as an organisation was named a responsible investment leader 2 years in a row. We just submitted our survey for this year, so hopefully it can be 3. We have a very large team. We have 19 investment professionals, anywhere from private up into large caps, and I'm sure you've had contact with some of our analysts at some stage. Next slide, please. This is a little bit of a highlight on the funds that I work in primarily, which is the Perennial Better Future Fund. We also have an active ETF called IMPQ. I guess what I wanted to demonstrate here is that we are a sustainable first product. We try to be as authentic as we can be. We're investing in the small and mid-cap part of the market, and we're really seeking companies that have a positive environmental or social purpose. Now, the reason we're seeking out these companies is because we actually believe that they provide the best investment opportunities. They're typically solving global sustainability challenges. We believe there's many tailwinds to be had for these types of businesses. And actually, in my opinion, the small cap market is a fantastic place to find these ideas, mostly because we're avoiding some of the sector bias that we see in the large cap space. But we find it's the smaller companies that are actually doing really interesting things in sustainability, despite being smaller and maybe not having the resources. And we can touch on that in a little bit. Next slide, please. This is just a snapshot of what we do across all of the funds at Perennial. So it's not just our dedicated sustainability funds where we're thinking about ESG. We are doing integration across all of the Perennial products. And we're putting it through all aspects of the investment process. So we're incorporating it into our research. We're looking at it as part of our valuation and assigning it as a risk factor. We're excluding companies. Depending on the fund, the exclusions slightly vary, but these are some of the main ones. If we do happen to hold a company that has a sustainability concern or doesn't score well from a sustainability perspective, we may still hold it in some of our non-dedicated sustainable funds, but it will typically be held at a lower weight to account for that risk. We also have an internal scoring mechanism, which we rate probably every single company on this call, and the fund in general has to have a score that's greater than the market. So it does actually have an impact of your score, depending on how much weighted position we will hold in our portfolios. Next slide, please. And I think Carly touched on this, but I guess from a funds manager perspective, if we don't have a sustainability strategy or we're not thinking about ESG investment, we're going to miss out on a lot of the fund flows. So we know that sustainability funds are gaining majority of the inflows, that they're growing. Historically, it has been off a small base, but it's becoming increasingly significant for fund managers to have a sustainability strategy, because otherwise they're going to miss out on a really large flow of capital that is only continuously improving and getting bigger. Next slide, please. There's a few reasons for this. One is consumer preference, but also performance. So this is the Dow Jones Sustainability. It's a US study, but I've seen studies all over the world. This is just one example. And you can see that the sustainability index has outperformed the S&P 500 index. There's a few reasons for that, and I will discuss that in a minute. We have seen some weakness of sustainability funds of late, primarily due to the underweighting of resource stocks in ESG companies, which have been performing quite strongly, particularly in the small end of the market. But in general, we do see that sustainable funds or sustainable companies tend to perform more strongly over time than non-ESG peers or lower ESG rated peers. Next slide, please. These are some of the reasons we have seen why that is the case. I won't focus on everything here, but some of the key aspects I will touch on briefly. So what we tend to find, studies over time across asset classes have shown that typically higher scoring ESG companies do have better returns and profits. I guess one of the reasons for that, which makes a lot of sense, is that consumers are demanding that the services and goods that they purchase from have sustainability credentials, and they're likely to shift their buying preferences based on the sustainability of the associated firm. And even more so, what we see is consumers are likely to want to be paying a premium for companies that are more focused on sustainability. So you see that maybe it's the recycled plastic bottle, water bottle, or the sustainable toilet paper. Consumers are increasingly willing to pay a premium for that more environmental or socially conscious product or service. What effect that typically has is that we find that companies performing better on sustainability will likely have a lower cost of capital, which ultimately leads to higher valuations. And that's really important as a business. If you want to be capturing capital at attractive value, at attractive pricing, we find that sustainability companies typically are better able to do that. We're seeing that both in the fixed income and equity market. We've seen sustainability-linked loans, which offer discounts for sustainable performance of the business. So it really is important from a cost of capital perspective as well. And I thought just in a tight labour market, which I'm sure we're all feeling the pressures of, it is quite important to have a sustainability purpose or corporate ESG, because our employees care about it. We are finding that sustainability companies tend to have a greater talent acquisition and retention. Their staff are more engaged, which of course leads to a whole amount of benefits, including better productivity. So there's really a whole section of reasons why we should be thinking about sustainability in our business. Next slide, please. I don't know if it's obvious or not to you. I'm sure it is, but on the left-hand side, I've just flagged some of the differences that we see in small caps versus large caps from a sustainability perspective. And it's something that we're very aware of and we don't take, for granted. We know that small companies typically have the less resources to produce these shiny sustainability reports, to talk to investors about sustainability. We understand that is a resourcing and budget concern. But what that leads to is typically larger companies score better in general from a sustainability perspective. Why that is because the external sustainability ratings, typically how they work is that they look through your disclosures and they'll say tick for a policy or tick for a certain type of disclosure. And that obviously favors larger businesses that have the resourcing to be able to do that. We also find that small caps are less subject to collaborative investor groups. So there's, I don't know if you've heard of them before, but Climate Action 100 Plus, which is all about targeting the world's largest greenhouse gas emitters to align with the Paris Agreement. Locally here, we also have IAST APAC, which is Investors Against Slavery and Human Trafficking, targeting supply chain risk from a modern slavery perspective. And so obviously small caps tend to kind of be missed in these collaborative engagements. But how to overcome some of these issues? Well, I guess what I think I would start with is to get buy-in from all levels of your organization. So, it's fine for the general employee to be leading some sustainability practices, but we really need it to also be from the top down level, at the board, at the executive. We want to see the buy-in from all levels of management, and that will really help to drive the focus on sustainability. I guess the point I want to make is you don't have to do everything. We don't expect you to do everything. I guess focus on what is the most material to your business. Now, what is the most material to your business? Well, that will really depend on your individual company and your sector, but it is important to engage with stakeholders about what those material issues may be. I've undertaken a number of materiality assessments for businesses to help them identify such issues. But you can look to your peers and what they're focusing on, but it is quite specific to each individual business as to what's material. What I would say is that there's kind of 3 topics that I focus on across every business. That is greenhouse gas emissions and alignment with the Paris Agreement. Whether you are a small cap company with a very low emissions profile, it is increasingly becoming a ticket to play to have disclosures and set targets. So that's one thing I would really focus on. Diversity. For us, we've been doing a large push into gender diversity at the board and executive level and increasingly in the line management role. And we can talk a little bit more about that later if it's of interest. And modern slavery in the supply chain is still quite important. And we know it's, present across every single one of our supply chains. And so managing those risks is super critical. But get your staff involved, and you'll actually find that there's probably a lot of people in your organization that are passionate about sustainability and want to feel like they are contributing to the sustainability credentials of your organization. In saying all of this, what I hate to see is when companies come and talk about sustainability and paint a sustainability message, but they actually don't believe it, and you can tell if it's not genuine. So I just put have a purpose. Why are you actually trying to increase the sustainability across your business? What does it mean for you as an organization? And I've also put here, talk to us. We do a lot of work with the companies that we hold on ESG. We actually keep a list of directors, female, really great and well-qualified female directors to help appoint some of them to boards that may be struggling with gender diversity. We do a lot of discussion on disclosures and best practice. So particularly if you're held by us, I'm more than happy to have the conversation on ESG. Next slide, please. I just wanted to give an example of what we've done as a small business and what we've been able to do from a corporate perspective on sustainability. I know it can seem overwhelming, but taking little steps is really important. And, even though we are a small business, we've actually developed an internal sustainability working group with members across all aspects of the business, from operations to sales to investment. And we actually have 1/3 of our staff participate in that group, which is really great. But we've developed a reporting suite. We do an annual ESG report. We do an engagement report. For our Better Future Fund, we do an impact statement. We do an annual sustainability survey called the Better Future Survey, which we probably have asked you in the past to complete. We'll be having our 4th one coming out in a couple of months, so we'd love your participation there. We've measured our Scope 1, Scope 2, and Scope 3 greenhouse gas emissions profiles. We've become carbon neutral as a business, and we've switched to 100% renewable energy. We've joined a number of industry groups and do quite a lot of participation within those groups. We recently submitted our first draft reconciliation action plan. We're looking to voluntarily report under the Modern Slavery Act, and we've also recently ran a diversity survey internally in our business. So there are little things that you can do, even if you are small, particularly if you have buy-in from staff. Next slide, please. And I guess just in summary, why you should really care. Well, you can gain the incremental investor. Increasingly, funds are moving towards being labelled as ESG, or we're having new funds come to market that are dedicated to sustainable products. You can expand your investor base by having a sustainability message, purpose, and credentials. And so I think it's really important to ensure that you're widening your investor base and opening yourselves up to as many potential investors as possible. As I mentioned, companies that perform well on sustainability are likely to have a lower cost of capital, which is beneficial for your business. We know that our employees care, which is critically important in the current hiring environment. And I guess what I wanted to leave you with, that it's not just a nice to have anymore. It really is a ticket to play. If, we're looking at sustainability credentials of our investee companies across all of our funds, from private, micro, smalls, large caps, and I just think that it's no longer just a nice to have, and you think, oh, it's just for the really sustainable investors. It's not. It's really widespread, and of course we want to avoid reputational damage. So we do find that companies who are focused on ESG and sustainability are likely to have less ESG controversies, and therefore you're not as likely to have some of that reputational damage that we do see can exist from ESG controversies in the market. And that's all from me.
Thanks, Emilie. A great presentation and very insightful. And I think for the audience, which, as I said, is 99.9% ASX listed executives, getting those insights are so valuable to them, and to enable them to understand why ESG and implementing and enhancing ESG is a key element to attracting funds and attracting investors. Like I said, there will be plenty of time for questions, and there's lots of questions coming through. So, Emilie, we will leave you now, and we'll bring you back in a little bit to jump on the panel, because, as I said, there will be a lot of questions coming through, which hopefully will save you from a lot of phone calls, or it may get the phone ringing. Lastly, but by no means least, I'd like to introduce Dr. Tim Siegenbeek van Heukelom, Chief Impact Officer at SocialSuite. Tim, I hope I got that right. With the facts now clear and the rationale of ESG-focused funds now known, Tim will provide you with the insights into what you can be doing now to start or enhance your ESG practices and processes within your respective ASX-listed organisations. Tim, over to you. Thank you very much.
Excellent. Thanks, David. We've had a really good overview of why ESG is important. So the big question now is how we actually are going to do that as a small cap. So there's a lot of challenges around that, and I want to talk to you about that today. The challenges that micro and small caps face in getting started with the ESG journey, but also then some real examples of companies that we work with. So we can go to the next slide. We'll start with a little bit of background about SocialSuite. We're a global leader in impact technology, and we're founded in Melbourne in 2014. We have offices in Australia, in America, and Canada. And what we do is we really work with companies, organizations at large, all the way from not-for-profits to publicly listed companies, to give them the technology they need to measure and drive social impact and ESG. So we have a whole customer base around the world that really kind of get into the complexity of these things, but we really help them simplify that by providing the right platform and solutions around that. And in particular, in Australia, we now have around just over 70 ASX listed small caps that use our ESG platform to really start that ESG journey and to start disclosing information in a standardized and recognized way. So really what we just heard from Perennial, from Emilie there, is like start that journey, start compiling information around ESG. It's better to have something than nothing, but how do you get started? That's what we help companies with. So if we go to the next slide, we'll see that some of the companies we work with, over the years, we've worked with many organizations to help them disclose impact and create value. A lot of companies listed on a variety of exchanges there as well. So this is a quick snapshot, and we'll dive into 3 of these companies in a bit more detail a bit later on as a case study, and how do they actually drive and create value from ESG. So on the next slide, we go there. What we do is, like I said, we help in particular small and medium-sized companies. And that's quite different from if we look at the large caps that have been in ESG, in sustainability, corporate social responsibility. They've done a lot of work there already. They often have teams in place. They have their frameworks. They have their own pain points, so to say, in terms of sustainability and reporting. So that's why we said we want to get the companies that feel that urgency, that accelerating urgency around ESG, want to help them get started. They look at the market and they see there's complexity, there's an issue around capacity, there's often a cost issue as well to get started with ESG. So how can we help them to get started and really make progress over time as well? So we really focus on the small caps. We work with a lot of micro caps as well, some medium-sized companies there, but that's the area that we really can help you out with. So next slide, please. And what happens then is when you're small cap, so you might already been looking now, you're listening today, this is one of the webinars you're listening to, and you understand ESG is important and you feel that urgency. But when at night you do a search online and you type in ESG, it looks very complex. There's a lot of acronyms. It's an alphabet soup, like Carly said there. There's a lot happening in terms of frameworks, standards, ways of doing things. It looks quite expensive. So certain solutions, certain consultants that can help you. It looks difficult and time consuming. So there's a lot of issues around that. And if we look at the next slide then, what we'll see is there are also still some misconceptions in the market around ESG. We see some people we talk with, they feel strong pressure from stakeholders, they need to do something. They're asking the question, well, it's only for sustainable businesses, right? We say, well, it's not for sustainable business only. It doesn't matter. ESG is business model and industry agnostic. So really what that means is that ESG effectively applies to everyone. It's not something that's only if you run say a wind farm or a solar farm, you help with that energy transition there. Now, ESG is a way of making sustainability related information available to your stakeholders and investors. You don't need to be perfect as well to get started. So there's no need to delay things till you feel like you tick all the boxes, have all the policies and mechanisms and reporting structures in place. It's better to provide some initial partial disclosure information now than no ESG at all. And I think that goes to the point we heard from Emilie as well, that if there's nothing there and the scoring agency go through it, they can't score you any points. If you have some information already disclosed, you get a much better ESG score. And ESG is about that ongoing journey of improvement. My investors don't care about ESG. We hear that from time to time, less and less and less. And over 2/3 of investors already screen for ESG. So it's mostly just a matter of time until your investors care about that. We hear as well that ESG doesn't align with our core priorities. We hear that now and then, also less and less, with ESG now becoming really a global priority. Like Carly said as well, reflection in the Australian elections recently, a lot of initiatives already happening. ESG is simply really doing good business. So start looking at that. And if it doesn't align to your priorities, have a look at your priorities and see it. How can you start building and embedding ESG into what you do? And the final one, and that touches again on that previous slide there. Yes, ESG is often expensive, difficult, and time consuming. And to a degree, yes, we agree with that. But it's all about looking at the complexity of ESG and then looking at solutions that are fit for size. So we're looking here at the small caps there. What is fit for size? What is simple, standardized, and what can get you going quite quickly at an affordable price level there? So if we go to the next slide, then what we'll see there is we've really tried to create a fit for size ESG solution. Of course, this looks pretty simplistic, this diagram here, but what I want to show you here is that we have the technology, that ESG platform there. But the core thing is what we find in particular with smaller size companies, it's not a matter of just having technology or software at your disposal. It is also someone that helps you actually understand how to use that, how to do that materiality, how to actually understand what is a priority, what can wait a bit longer, how do I interpret this particular metric there? And that comes in. The other part of our solution is ESG coaching. We have a team of ESG coaches that really guide you, that explain what the particular metrics mean, how you can collect that information, and he really help you plan and schedule and coach you through getting to your first ESG report. And from there on, help you make incremental progress, improve your ESG metrics and your disclosures to drive that ESG value. And that's on the next slide. There's a few common areas there that were defined by the United Nations in an initiative for stock exchanges, where they said, what are those key areas in which you can drive value from ESG? Now, the common one that we spoke about is it helps you really access capital. So that's a pretty clear one. Carly also touched upon compliance. That is coming, so I won't say much more about that. Risk management is also a key area there. But we also see increasingly, we see people that have already invested into your business. They want more information. They say, well, I'm already invested into what you're doing, but I want to see how are you managing, not on that financial disclosure side of things, but I do want to better understand from a governance point of view, corruption, whistleblower policies, diversity on the board. I want to see what are you planning to do around climate forecasting, the Paris Agreement, 1.52 degree scenarios. Provide us that information. Then on the flip side of risk management, there's also opportunities. So really profitability and growth. We've already seen that companies generally that do ESG, that embed it and really institutionalize it in how they operate their business and govern their business in a responsible way, that in turn the profitability will be better. There's also a lot of opportunities there that we see that small caps in particular, they're more nimble, they can capitalize on opportunities quite quickly. So we've had examples of companies that suddenly noticed that something they're already doing around carbon enabled them to create carbon credits and create a whole new stream of income around that. So it's really starting not to look at risk only, but also look at that growth opportunities. Reputation and branding speaks for itself. And then the final one is around measurable achievements. And that's a quite interesting one where we see companies saying, well, we're already report against the United Nations Sustainable Development Goals, or we are committed to be carbon neutral by 2050, which are great commitments, but you need to walk the talk these days. You can't get away with a commitment. So you need to demonstrate then, if you set yourself and if you align yourself to a global target like the SDGs, demonstrate to your stakeholders how are you actually contributing to that. And ESG is often a great way in demonstrating how you're doing that month by month, quarter by quarter, and over a year. What is that actual progress there? So we go to the next slide then. What we help companies do is on the one hand, really get started with ESG and demonstrate progress. So we help you create a snapshot of where you are. So we see that dashboard and progress report, and that is really meant to have a quick overview, again, a set of defined metrics, and I'll talk to that in a moment, but really help you at that executive and governance level to quickly see what are we focused on, what is our priority, and where have we come from quarter to quarter or even from month to month, because that's the key thing. ESG should no longer be something that is a end of year sprint, a vaulted-on approach where we'll do something at the 11th hour, put a report together, and then don't think about sustainability or you see the rest of the year. It should really be embedded in everything you do. It should be the lens you put on pretty much every day, business as usual. So those dashboards and progress reports are really useful to have that discussion internally. But then underlying all that is ultimately your disclosure report. So what are you actually disclosing the information on an ongoing basis, on an ad hoc basis to your stakeholders when they ask for it, quarterly ideally, to make sure that you provide frequent and regular information. And then, of course, once a year, we see a lot of companies still do an ESG or sustainability report. So we really help you get that information collated in a standardized and recognized way and get that information out to your stakeholders. If we look at the next slide, we'll see that framework that we use. What we really look at is there's a lot of voluntary reporting standards out there globally that you can use, but what is a good starting point for a small company? Now, that question was asked a few years ago at the World Economic Forum, where the International Business Coalition came together and said, we need a good starting point for smaller companies as well, something that every company should be able to report against. And that is a really good cross-section of everything that's already out there. So a good overview of what you're doing around governance, how you're impacting the planet, how you're taking care of your people, and how you're ultimately, from a sustainability point of view, still driving prosperity. 21 core metrics that we get you started with, and then the 34 in the same framework, which are expanded metrics, and that we'll look at down the track when you're comfortable with that first 21 disclosures, you're comfortably reporting and have embedded that into your business as usual. Now, the next slide then, please, case studies. So if you go to the next slide straight away, how do we make this real? And I think that's the key thing. We can talk at length about theory, about examples, but let's dive into some of those companies that actually done this work with us. The first one is Latin Resources, a relatively small company, have operations in South America, and they've been doing ESG in the sense that implementing in their business for a long time. Their problem was, they said, we believe we do a lot of this ESG work, but we don't know how to report it. It is a matter of capacity, of a standardized way of doing this, of understanding what we should be reporting, and then just getting on with the job. So how do we report and make incremental progress after that as well? We don't want to do this as a one-off exercise. We want to, over time, really quickly show that we improve where we can. So we really helped this company get that first ESG report together with a really strong kind of prioritization by the business itself. Executive director, there's an ESG lead. So it was really about getting a report together. So we worked with Latin for about a year. And then at the start of this year, they released their first ESG report there. And really quickly after, they did a cap raise. And that was really a transformational raise for the business. They raised 35 million, anchored by 15 million from a Canadian ESG fund. So within a month, pretty much from releasing that first ESG report, they straight away accessed capital. Was a big thing for their reputation and branding as well, large in the market. We also got a lot of feedback hearing like, wow, Latin Resources really setting an example there in that space. And there's also been a lot of visibility again around that from their report on their website. They've shared it, widely with their stakeholder base. And we recently did a large piece on Sky News as well with Latin Resources to talk about how is it as a smaller company to get this ESG journey started. So really a good case study of a small company into that resource sector that felt strong urgency, believed they were doing already something at a business operations level, but how do you capture that in an actual report and drive that to the market? And another example is on the next slide. Slightly larger company, OptimizeRx, they're one of our US-based customers listed on the NASDAQ. The health technology company. And yes, they released recently their first ESG report, which is a great thing in and of itself. But the unique thing here is that as a slightly larger kind of, company there, they already felt that urgency to do something around ESG. A lot of stakeholders had been asking them around that. They said it really literally keeps me awake at night, but it's so complex and overwhelming to, get started with this. So how do we start with this? And the unique thing here is that it was really a company-wide driven approach from all the way from the CEO down to the general counsel, and then a large team of about 24 people in that first meeting we had with them that were all ready to go and said, we want this done in a recognized way, in a robust disclosure report, but we also want to do this quite quickly. So we have a designated team here, an ESG lead. We'll do what it takes to do this really well. And they released their first full ESG report within 2 months, maybe been even quicker than that. They've really embedded ESG in their business as well in terms of how they do things. And they've really set in place now structures and processes to make sure that they follow through, from quarterly ESG working groups to making sure it's on the board's agenda. So really a good, interesting approach in picking up ESG and quite quickly getting that report out to the market. And then the final one, again, a different type of company here, unlisted company on the next slide, where we see here Binance Australia. So Binance is a global digital currency or crypto exchange. You might have heard of it. They're the largest crypto exchange in the world. And they have different regional offices. And Binance Australia recently announced that they were the first ESG reporting digital currency exchange in the world. Closely watched by Binance Global. They're really looking at how their Australian kind of arm is doing this and looking at if they can adopt that across the world. Strong kind of drive by their CEO, Lee, who's really said we need to do this well. We see a lot of issues at large in the crypto space. It's being perceived as very high carbon emissions, a bad reputation around that. We want to demonstrate that the digital asset industry can do ESG. We want to show a commitment, but also demonstrate that we deliver on that commitment and have continuous progress there. So they They're still working on a full first report, but they put some really good first disclosures already out to the market, targeting also net zero carbon footprint. They secured their first institutional partner with an ESG conscious focus, and they're really disclosing a lot of this information on an ongoing quarterly basis to their 700,000 people kind of stakeholder list there. So very visible. So those three examples give you a really interesting overview of, I guess, different jurisdictions, company sizes, industries, listed and unlisted businesses. So ESG truly is for everyone, and that's the example here. I want to just show you everyone could and should and ought to be doing this. It's just a matter of finding that starting point. So if we go to the next slide, then take action. So what can you do today to get started? The solution for small caps that we believe is really important to think about is that standardization. Think about a single framework. They're working that globally right now at this point for small caps. That stakeholder capitalism framework from the World Economic Forum is a good starting point. It's a good foundation to get started on that journey. Think about incremental reporting. Think not about being perfect overnight. Make progress. Do that continuously. Report frequently, quarterly, ideally to your stakeholders, and really as well build internal capacity. So don't outsource everything. Look at what can you do with that limited capacity. How can you best utilize that and build up some internal knowledge and understanding of what ESG is and how you can report it on that. And engage everyone. So institutionalize it across the executive board, management, employees. Make sure everyone is skin in the game there, feels involved and empowered to work on ESG. And then don't only look at the risk and the risk mitigation, look at all those other opportunities and the value you can create. That's really important to keep in mind there. So on the final slide then, you can start today. So it is really something that take that complexity away, commit to it today. Just say to yourself, okay, I'm going to do something today. I'll look at if I can find that right starting point. I'll get some help there to get that first ESG baseline report completed. And soon you can share that with your stakeholders and really demonstrate that you're doing something. So it's really about showing the market that you're doing something here, you put it on the radar, you commit to doing more and improve over time. And that's something we can help a lot of small caps with. Thanks, David.
Thanks, Tim. A great presentation. And as you say, given some really good insights and tools that companies could start to use now to start or enhance their ESG journey. It's now my pleasure to welcome back each of the presenters, Tim, who will remain on the screen, Carly and Emilie. As mentioned, we'll now be running an interactive Q&A session with these ESG experts. I urge you to ask questions using the Q&A form on the screen, and we will endeavour to get through as many as possible. I've already got a pile that have come through, so we'll just jump straight into it. I will direct questions at each of you individually, but if others have a view, please feel free to jump in as well. Carly, first one to you. Are you surprised by the speed by which ESG has moved from a nice to have to a must have?
That's a great question. I mean, I think it's an interesting one because I think as COVID hit 2 years ago, many of us kind of held our breath in this sector, wondering, what was going to happen, because there was already a really positive trajectory in terms of adoption and growth around sustainable finance. And then, obviously a global pandemic meant a lot for businesses and financial markets. So, I guess there was a bit of holding of breath, and the actual opposite happened. I think what it did do, almost at that meta level, was showed people globally how interconnected everything is, how interconnected our health systems are with, what can happen in a market in China. I think in many ways that was a bit surprising, but it was really, really fortuitous, and we're not looking back from that point.
And do you think we're leading, or are we following and catching up?
Look, I think what's really interesting, from a legislative and a regulatory environment, we are absolutely behind the eight ball. There's no doubt about that. and that's been for some years now. So there's a very big catch-up game, and some decisions that the new government will need to make around how much it steers the course. But in the absence of that leadership and that framework being set in Australia by government, what we've really seen is the industry just coming together saying, well, we need this. This is actually good for business. So we're going to bring in frameworks. Yes, they'll be voluntary, but we know that it's good for business, and we know that it's going to position us competitively well to be taking the lead on this. So there's so much momentum here happening already. So the Australian Sustainable Finance Institute is currently embarking on setting a whole sustainable finance taxonomy in Australia. Now, in the UK, in Europe, that's been led by government. In Australia, it's been led by the industry. We're hoping that the government will play a role in that, absolutely. But yeah, it's been fantastic to see the industry. I think Emilie would probably have something to say on that as well.
Well, Emilie, I was just going to say, I saw you nodding your head as Carly was giving those answers. Is it also a case of it's not, I'm not going to say irrelevant what government and legislative groups do. It's more a case of if a company wants funding and it wants to open itself up to funding opportunities, globally, those funds are asking those questions and are forcing that change and that implementation. So it's almost, it's happening whether government's there or not. It's just the companies need to follow.
That's exactly right. And I won't make a comment on the regulatory environment, but what I would say is that consumers and investors are moving in their own pace, and that is a really accelerating pace. And it's interesting, I've seen some research and some, people talking about sustainability in the current volatile market. And what we've seen is that it's still the number one topic at the board at the moment for the largest global businesses, which means it's still going to remain on the table. We have seen flows slow down a little bit, but that's in the context of global flows slowing down. So actually, when you isolate the responsible investment strategies, they're still experiencing greater inflows than the rest of the market. So, we have been tested over the last few years, particularly with the pandemic. And, I was told previously when a downturn happens, sustainability is going to be the last thing on everyone's mind. And what we saw was the opposite, because there is that huge movement that's happening led by the consumer. If there's no demand, obviously it's not going to be a driver. But we've seen that momentous shift, particularly as the millennials who care about these issues more move up into the wealth spectrum.
And Tim, I suppose drilling it down a little bit further, a lot of this audience is micro, small, mid caps. So they're all sitting there watching the presentation thinking, what do? I don't have a sustainability team. I don't have a big advisory group who can come in and just knock all this into shape. Or I think I'm too early for this journey. What do you say to those companies, and how do they start the journey? What's the get the ball rolling? What are some of the quick wins they should be looking at?
Great question, and we do get that daily. It's exactly that, where there's a number of companies really early days going to IPO, say, we believe now, even in that process, in our prospectus, we want to demonstrate that we are doing something around ESG. So we work with quite a few that are on that pathway to IPO. We really work then with mostly directors of the board, maybe the CEO there. So it's really at that level, smaller companies, they feel that urgency. We sit down and we work out what are the immediate steps that we can take. So we review with them where they are, where they want to go, what some of the targets throughout the year, set up a timeline. And then really the first thing is just looking at where you're today. So it's not about improving anything, it's just what do you already have? And there's quite a few companies that already have a lot of information that are ESG disclosures in effect. It's just about putting it in the right framework, putting it in a report and showing the market that, yes, you're a listed business potentially already. You have an anti-corruption policy, tick the box there. So it is that approach there. And then going forward from there, we really work a lot with, mostly at that C-suite level, the CEOs, the CFOs on the reporting in those smaller businesses. And sometimes we do provide them with additional support as well, where they say, we really need more support here to get a report quickly together, to make some improvements there. So we have a certain level of additional support as well, but we do see that the majority of companies are really genuinely interested in doing it themselves too. They say, this is part of what we want to understand. We want to know what ESG is and how it works, so educate us. So there's a lot educational part of our ESG coaching as well that we provide small companies.
And Emilie, just taking that sort of a step further, if you've got companies coming through your door, whether they're a micro, small, medium cap company, do you sometimes look at them and go, guys, you've got some really easy wins here that you may not have seen or may not have noticed that tick a really big box when I put you into the scorecard from an ESG point of view?
Absolutely. We have companies all the time that are doing things in their business just because they believe it's the right thing to do for their employees, for their customers, but they're not actually disclosing to market. And we can only know what's publicly disclosed. We can only see what's in, the annual report or the presentation or the sustainability report or what's on the website. And that's some of the biggest work I do, is pointing out, I know you do this, but it's not anywhere that's publicly disclosed and people are going to overlook it. So make sure your disclosures are fresh and up to date. Make sure your ESG section on your website isn't, kind of a second thought and isn't, 5 or 10 years old, which I do see, because that's where we go to source ESG information.
I totally agree there with Emilie. Like, that's the key thing. There's so much you are potentially already doing, but it is getting it out there. It's getting it to the market, making it visible. So that's one of the key things we do as well. That first instance, like, tell us what you already do. It's a baseline. It's just going through, what are you doing around planet, around people, around governance? What do you already have in place? And let's demonstrate that. And after that, we can talk about how can you improve, how can you be better. But let's first get the quick wins out of the way, and there's often already a lot there.
Now, I've got a lot of acronyms being thrown at me, so I apologise if I get something wrong here. I think this is a question for Emilie and Carly, but we'll jump into it. So what are your views around the adoption and compliance to specific sustainability standards? For example, is it or becoming an unavoidable requirement that mining companies are subscribing to a standard like IRMA, ICMM, TSM?
I'll just make a quick comment and then maybe Carly can go in. I think, there are some useful disclosing initiatives that are out there, and there are some sector specific, which you should look into. I don't think you need to do everything. Pick the one that's the most, for your most fitted to your organization. Talk to your stakeholders about what they want to see, your shareholders as well, because they may have a view. I don't want to make specific recommendations when I don't know the company, but definitely make sure it's the most relevant to your business. And as Carly mentioned in her presentation, there's no globally accepted framework that's regulatorily required. So it is all voluntary. So I think pick one or two of the best choices and use that. You don't have to do every single one.
Yeah, I'm not actually across all of those acronyms in that point either. But I mean, what I will say is that there are various jurisdictions, as I mentioned, including New Zealand, where the Task Force on Climate-Related Disclosures is mandatory. So, that's an important one. And another one that's coming down the line is the same one around nature. So biodiversity is going to become more and more prominent, I think, in terms of organisations really unpacking and understanding their risks, nature risks and biodiversity risks. So I'd recommend having a look at those areas, the TNFD as well as TCFD.
And Carly, ratings and ESG scores appear to be disparate in terms of who's completed the study. Will this change and move towards general guidelines and competent persons to assess a business for ESG?
Yeah, look, I mean, I think there's certainly some truth to that, just as there's kind of, truth towards anyone kind of doing projections or looking at a company's performance will come up, if you get 5 different people in a room, they'll come up with 5 different figures as well. So it's not an exact science. I think that's one of the things that RAIA is looking to the government towards, is actually bringing more consistency across how that assessment is done across different providers as well. So it's a challenge, but Yeah, I think, it's there's no perfect. It's not perfect in the financial side of the equation either.
So this is a broader question to everyone, and clearly we've got a lot of gold exploration companies on this call. Where do the speakers see gold explorers making a mark with ESG? Without mining operations, anything can be said about future aspirations, i.e. no cyanide, etc., but these are not concrete right now. Is it smaller scale things like appropriate contractor selection, diversity in employment, interaction with traditional owners, plastic minimisation, etc., where the real wins can be generated now?
I might just jump in there in the first instance. I kind of separate sustainability in my mind into two sections. So you have the actual impact of the business and how it's impacting the environment and society. And then you also have the corporate sustainability as well. And how we look at it combines both. But there are some corporate initiatives that are applicable to all businesses, including mining. So I think in that question, there was things like diversity. That's really important. Community contributions, what you're doing for worker safety. These are all things that we would expect from a corporate perspective anyway. And then, of course, minimizing your impact on the environment is obviously relevant as well. And I agree, people have the tendency to make large claims about the future, and we do look at those claims, but we also look at the steps to get there, and are they making progress every time we talk to the business? What can we see improving each time? Because this is a whole another conversation, but greenwashing is very prevalent, and we need to make sure we hold companies accountable to what they're saying. And one of the best ways I've seen to do that is to tie it into remuneration and hold the current executives accountable. So a great example of that is greenhouse gas emissions setting a 2050 target. Well, that's great, but the current CEO is not going to be the CEO in 2050. So what small timeframes are you setting targets for to hold that executive accountable while he or she is still in position?
We work with a lot of small cap mining exploration companies, and it's quite an interesting thing to look at. Yes, like Emilie said, there's a lot of, common ESG metrics and disclosures to provide information on. So there's a lot of work that can be done, and there's always something that is more specific to the particular industry that is making more material, or there's no materiality for a particular company about that. But what we see with the mining companies there is that there is that drive on the one hand for the energy transition. So we'll see a lot more mining to make sure that people can have their batteries and have their phones and their EVs. But all that mining, of course, needs to be done responsible as well. So that's that environmental side of things, that it's managing both sides of the equation there. Yeah, it's being transparent about what you disclose, and disclose as much as you can, but also then in how do you actually responsibly run your business and govern that, and then feed that back again to your stakeholders. Those are the key things there, really.
We've got a few more minutes for questions if there's any last minute ones coming through, but we still do have a poll to get through. A question, I suppose, for everybody: at what point does ESG disclosure become data driven? The question is if we start disclosing under WEF, for example, when do measurable metrics transition from disclosure, changes to corporate governance, and onto deep data?
So what we see is with the companies that we start working with, their capacity is quite limited. So we work again from the principle that do what you can today is better than nothing at all. So we start working with them on the low-hanging fruit there. What are the things that are not heavily data-driven there, but flagging those initiatives they should be doing? So carbon emissions, greenhouse gas footprint, that is really important there. So start that work on that, start to understand what's required. We'll really guide them in that process. Like, what's a good fit for size in terms of what is your operation? Who is the best help there to get a carbon footprint together? But there's also a lot of disclosure that are more, in a sense, smaller disclosures that are not heavily data-driven from that perspective. The company can start reporting on it, thinking about, like, what do we have in place here? How can we elevate that discussion to the board around risk and opportunity and put a process in place? So there's a whole range there's definitely some data-driven points there, but there's also a lot of policy, procedure, and embedding ESG thinking at large in the business there, which is a lot easier for a small cap to start with if you don't have a massive team that can actually do the work.
Emilie, one final one for you. Now, in Tim's presentation, he mentioned that investors are now screening more than ever companies for ESG. As a fund manager and someone who looks at this and breathes this information daily, how do you screen a company? Is there some standard tick boxes you look at right from the get-go? And for a company that doesn't have these policies in place and doesn't have the systems in place, what are the things that if you were talking to a company or the couple of hundred who are talking that are online here today, that you say to them, guys, just do this, 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 and this as a starting point, and at least then the door's starting to open?
I hate to not give an exact answer here, but it is really company specific. I wouldn't know without knowing what sector and what individual company and where they're currently sitting. We do things a little bit differently at Perennial to other funds on the market in that we actually do our own scoring mechanism. And so we determine what is material for that business and score them against that. External data providers will have a more of a tick the box approach on your disclosures. So, do you have a diversity statement? Do you have a ESG report? Do you disclose greenhouse gas emissions? Do you, disclose employee engagement or worker turnover or whatever it may be? We have a slightly different approach. But as I mentioned, the three key topics that I'm focused on basically every single business is the greenhouse gas emissions, the modern slavery, and the diversity, because they're really large global issues. And we're seeing the flow-on effects from the large global corporates all the way down through to the small and mid-cap space. So if you're looking for a place to start, they're the three biggest topics that I would look at, because that's what the sustainable investment community tends to focus on. But everything else is really company specific.
And Tim, when you talk about screening and you talk about giving companies advice, again, are there, and I hate using the word quick wins, but are there things that companies can and should be doing very quickly to implement that gets them started on that ESG journey or gets them some points on the board, so to speak?
Yeah, I think the number one thing is just basically going through whatever framework you choose to report on. It's just going through that and just do a baseline assessment of where are you today. So draw a line in the sand. What do I have? What can I disclose? And you might be able to populate half of that framework already with things that you have and then get it out. So when someone then looks at that, says, okay, we can see that you've already disclosed half of this information, where you can put a commitment, a time frame, a goal around what the next steps are to improve and provide more information. But having everything in one place, disclosures and information that you already have, but that is sitting across the business, collate that and get that in one place as a starting point. That should be an exercise you can do in a few weeks' time there. So it really gives you a really solid way of knowing where you stand and your stakeholders as well. And from there on, and look at what are the main initiatives that are material to our stakeholders and that we can improve upon over the next few months. So start larger initiatives, start thinking about TCFD, but also get a purpose statement, talk to the board, get that locked in and do that. So we really help you. But the key thing again, just look at where you're today and get that information out in a consolidated way.
A very insightful presentation and a very, very educational panel session. We could go for hours and hours. There's a lot of interest, but out of respect for our presenters who have lots of things to do and to keep pushing their own ESG activities throughout the rest of today, I'd like to thank Emilie, Carly, and Tim for presenting today. I'd like to thank the literally hundreds of ASX executives who've logged in to hear this presentation. A copy will be available and we will email a copy out to each of you. I suppose if as someone who's listened to the presentations and thinking, well, what did I learn? For me, it was educate yourself on ESG and understand why ESG is important for listed companies. Make sure you take a company-wide approach and that everybody jumps in and commits to ESG and look to how you can start the journey. It's not about racing ahead to step 100 on day one. It's looking at what you are already doing, implement those and expand and make informed, make that information knowledgeable to the external world so that people can understand that you are committed to and on the ESG journey, and then just take the steps necessary to expand on that as you go. By not doing that, it's become very clear that not only do you potentially raise the ire of your existing shareholders, but you run the real likelihood that you're cutting off a big investor audience who do want to see commitments in this area. So for someone who helps look after ASX listed companies and attract investors, it seems to me a no-brainer that ESG becomes part of their everyday life, and they commit to it and embed it into their businesses. So to Tim, Emilie and Carly, I'd like to thank you for your presentations. I'd like to thank everyone who watched today, and I wish everyone a happy and safe rest of the week. Thank you.